G'day guys, Jay Sini here and welcome to another episode on the Australian Wealth channel. And in this episode, I'm going to be talking about my most recent acquisition, which is a townhouse up in Brisbane. So thank you guys so much for watching. Please make sure you like and subscribe to this channel. Really helps to get these videos out to more people. So in this video, I'm going to be talking about my most recent property acquisition. So this is going to be property number 4 for me. And this is one that I want to explain a little bit about so you can have a look at what the numbers are like and why this deal makes sense for me and a number of other things going forward. So thanks so much for watching. Like and subscribe. So most of the time on this channel, I've talked about purchasing houses because houses seem to have more capital growth over time than units, things like townhouses and apartments, properties like that. So why is it that I actually went and bought a townhouse this time? Now, the thing is, if you want to continue to grow a property portfolio, it's prudent to have a couple of different types of investment in that portfolio, but there is a much more important reason too. Now, one of the main reasons that this property I decided to go with a townhouse is because of not only opportunity, but also because of cash flow. Townhouses and units traditionally have a much better yield than houses. Now, I'm starting to get to the point where my borrowing capacity is getting maxed out. So it's important to know that if you want to continue to grow a property portfolio, there comes a point where the bank's going to say, hey, you need to start paying down some of this debt. So because I want to continue to grow my property portfolio over time, it's important that these rentals that I have going forward have really strong cash flow. And this is something that I've talked about in previous videos about houses, but this is one that cash flows incredibly well. So I wanted to speak about this one. But on top of this, this is a deal that came to me from my buyer's agent, which is about 50 grand under market value. And the reason that I managed to get something brand new, 50 grand under market value, is because the property was under contract with someone else, but unfortunately their finance has fallen through. And because their finance has fallen through, this is an opportunity that's been presented to me to be able to pick up. So these are townhouses that are completely finished. They're in the Springfield Lakes area, so really happy to be getting a bit of diversity amongst Brisbane as well. I think it's a market that's going to continue to grow quite drastically into the future and has some great infrastructure spend going in, which is only going to raise the value of prices all around the place. So not only was it a great deal that we've managed to get around 50 grand under market value of what it would sell for if we didn't have it under contract from the builder, but on top of that, it's going to cash flow really well, which is so important going forward because as you start to get a few properties under your belt, you start to hit your borrowing limits. Banks will be a little bit more tedious and a bit more difficult about lending you money because obviously the more money you borrow, that's a little bit higher risk for the bank. So as this starts to happen, it's really important that your properties are continuing to cash flow and you're paying down some of the debt as well. So these particular properties, I'm swapping them all over to principal and interest so we can get rid of some of that debt going forward. Interest only is great for being able to grow a property portfolio fast, but in a situation like this where interest rates may go up because inflation might continue to grow, then it is prudent to start paying down some of that debt so you're less exposed to it. And that way, if you pay down enough debt, you can always look at reducing your payments and things like that. If things get quite difficult, which thankfully we're not in a situation anywhere near like that. So it's always prudent to be paying down debt because it's an amazing tool, but debt is very much like fire. If you play with fire too much, you can get burned. The same thing happens with debt. But of course, on the other side, it's also a very helpful tool. You can cook things with fire. With debt, you can grow your net worth significantly faster. So this is the reason that I've taken on this debt for these properties because it's continuing to grow my net worth and provide me money. Because as you know, there's two different types of debt. We've got good debt and bad debt. Bad debt being things like credit card debt, things that's not producing you money, it's taking money away. Good debt is producing you money through assets. This is a property that we are buying for about $460,000, and this is a property that will sell for just over $500,000, around that 510 mark, because the Brisbane property market has just been insane. So that's the price that we're paying. Now, this is completely a cash out refinance. We're getting the money for the deposit from our other property up in Brisbane. Because the values have grown so much, we're able to pull out a little bit of cash and we can go and invest that in this deal. So this is all money that I haven't had to actually work for. It's all just been from the assets that we own. So we're in the deal $460,000 in debt. So roughly those are payments of interest only, say, of around $1,100. If you're looking at principal and interest, that's going to be a little bit more. So this is a property that will rent for $450 at the minimum, all the way up to $500 on the top end per week. So if we look at that and we break it down, that's roughly $2,000 a month. We're paying $1,100 something in interest, and we're making a rental return of over $2,000 a month. There are a few other fees that we have to look at, including body corporate and things like that. Thankfully, they're not too high, so it doesn't really detract from the massive amount of cash flow that this property is producing. So we're getting paid to hold this asset, just like the one that we're doing in Monopara as well, down in South Australia. So holding this asset is going to provide us with a lot of cash flow, and it's going to be paying for itself in a very drastic way too, which is great. It's very highly cash flow positive, and I think that's something that's really important going forward, because we're in an environment where interest rates could go up. And when interest rates go up, it means that your payments are going to get more expensive. So you need to be buying properties that are highly cash flow positive. So properties like this, they have a fair bit of equity in the deal already. So this is one that I am really excited about. It's basically finished construction, so we'll have a tenant in it straight away. The vacancy rate of this particular area is incredibly low. It's under 1%, which is fantastic when you're looking to get this filled with a tenant. So this is going to be property number 4. You can see today I'm shooting on a green screen. I have access to one of these, which is fantastic. So it means I'll be able to show you some nice drone footage over the back of this image of the area that we are buying into. So I hope you guys enjoyed this video. Please make sure you like and subscribe to this channel. Really helps to get these videos out to more people. If you'd like to get yourself a free stock, I have a link to Stake in the description. Sign up with the brokerage and they will give you a free stock, which is fantastic just for depositing money in. And then on top of that, I have a link to WeMoney as well. You can track your net worth with WeMoney, and they'll give you $5 just for signing up. That's where I track my net worth. So thank you guys so much for watching. Please make sure you like and subscribe to the channel. Really helps to get these videos out to more people. So my name is Jay Sini from the Australian Wealth Channel. We'll see you later.